So we're going to be working on consolidating two firms where the parent doesn't own all of the subsidiary. And so we have non-controlling interest, meaning that an outside party owns part of the subsidiary, so we have to back out their portion of the subsidiary's income and dividends and assets, net assets. So let's go ahead and do that. We start here with the story where they tell us that the parent owns 55% of the subsidiary, Supter, and they paid $3 million cash plus some stock. And so the purchase price is not directly given. We have to figure it out. We have the book value at purchase time, and then we have some undervalued and overvalued items. So we have two undervalued and one overvalued, so we'll have to write two up and write one down in the consolidation. It tells us the market value of those shares, so that'll help us to figure out the consideration paid for that 55%. There was no control premium. That means we can use the 55% purchase price to figure out what the 45% was valued at. Any consideration over fair value goes to goodwill. Okay, so we can do that. They use the equity method, and here's the balances at the end of 2011. So what year is that? So year 1, 2, 3, what do we have? Looks like it's the end of year 1. Okay, real important to notice those dates. All right, so let's analyze what needs to be amortized and the goodwill and all that first, and then we'll come back and do all the entries. So let me set that up for you. All right, so the purchase price. What was the purchase price for the 55%? So it would have been the cash paid, $3 million, plus the shares, 500,000, times the market value of the shares, which they say was $14.90. All right, so that's what was paid for 55%. So if that's 55%, what's 100%? So we take that and divide it by the 0.55. So that's the implied value for the entire subsidiary, the 100%. All right, and then the difference would be the implied value of the NCI that would get booked into that NCI account. Okay, and then they tell us the book value. Let's move that up here. And the book value at the time of acquisition was $16,970. Okay. And so the difference between the implied fair value and the book value at the time of the acquisition is this $2,030,000. So we have to spread that. And then anything left over that we don't have anything to spread to becomes goodwill. All right, so let's see. So the land was undervalued by $850, so we'll write that up, $850,000. And then buildings were undervalued by $700,000. All right, and then the equipment was too high, and so we have to write the equipment down, which is possible. And so these added together are $1,150,000. So the difference between the $2,030,000 and the sum of these goes to goodwill. So there's our goodwill. Oops, put that in the wrong space, didn't I? I guess I meant to add these up and show you what the subtotal was there. Okay. So now, land does not have a useful life, so there won't be any amortization or depreciation on it. The buildings, they tell us, had a 7-year life, and the equipment, they tell us, has a 5-year life. So the amortization for each of the 7 years and for each of the 5 years, or depreciation, whichever you want to call it, is going to be a net 20, with 100,000 reducing that write-up of 700 and 80,000 increasing the write-up of the 40, because they're going in different directions. So be sure to be alert to that, and we'll see that when we start doing the entries. Here the entries remind you of what they are in case that's helpful to you. Just some notes there. So let's get started with the entries. Okay, so the S entry to eliminate the book value Okay, so there's the book value, and that's going to be split between the investment in their 55 and the non-controlling interest, their 45. And so let's do that. So this plus this plus this times the 55 for the parent, and then the same three things added up, but now it's going to be times 45. And let's check our debits and credits to be sure as we go that all is well, so we know to stop and not keep going until that's solved. Okay, that looks good. All right, so now let's do the A entry, which is to write up, or in this case, write down assets to the valuation at the acquisition date. So let's see here, land and building and equipment. Actually, equipment is going down, so let's put it over here. So land we had going up by 850, and buildings by 700, and then equipment is going down by the 400. And so, let's see, do we have all of it? Oh, the goodwill, which we calculated to be 880. Okay, so now the net of those four, the three increases less the one decrease, is going to be split 55, 45 between the investment in and NCI, non-controlling interest. Make sure our entry balances, which it didn't, so what did we do wrong here? Forgot to put the decimal in there. There we go. That happens. Okay, and that's another good reason to have this at the bottom here, right? You can immediately see, whoops, wait a minute, something's up with that one. Instead of doing all your entries and at the end it doesn't balance and you don't know where to start. So that was a good reminder of that best practice. Okay, so there's your A and there's your S entry. So now let's go ahead and do D. Let's get rid of the dividends. And so the dividends, the 55% are coming out here, and then the other 45% are going to non-controlling interest. All right, and then and that's a debit to non-controlling interest because it's positive. And then the D part is coming out here. And our entries are still balancing, so we're good to go. And then let's get rid of this income that was booked under the equity method that needs to be reversed, and that's coming out of the parent because the NCI folks didn't do that. And we're in balance again, so we're good. And we're ready to do the next entry. So let's depreciate and amortize this equipment and building that we wrote up. So that amortization for the building was 100,000, and then for equipment we're going to reduce the depreciation that was taken on the book because we reduced the book. So that's going in the other direction, and then the net is going up here in expenses, which is the 100,000 minus the 80. Let's see if our entry is in balance, and it is. Very good. Okay, so let's see, did we catch it all? Doing a quick scan here. Looks like we got it all. We're in balance. Okay. Now it's time to calculate the net income and put the portion of the subsidiary's net income that belongs to the non-controlling interest into the non-controlling interest account. So let's do that. All right, so let's go on down here. So now we want to, the non-controlling interest is not a function of this cell here, because this cell here has the profits of the parent as well as the subsidiary. And the non-controlling interest doesn't have any right to the parent income. So it is the non-controlling interest portion is from the subsidiary. So it's the subsidiaries plus any of these adjustments that belong to the subsidiary, in this case the 20,000. So it's that number times their proportionate share of income. So they get 45% of that. All right, and so that comes out when calculating the consolidated, the parent share of consolidated net income. Gotta spit that out. So this is simply a vertical, and then these two lines together. So that's the parent share. So that's what's going into the parent's retained earnings. Okay, so now let's continue here with the math. This is coming from above, so it's not going to be a math. That's coming from above, so that's not going to be a math. Trying to copy my little formula down here to the cells that it would apply to. Okay, the other cells it's not going to be added horizontally, so I've got to do that manually. All right, so net income comes from above, the parent share of net income, and this is now a vertical, not in the dividend cell. There we go. Be better if that was had a line there so I knew the separation of what belonged to retained earnings and what was a subtotal from net income. Alrighty, and so now this account is all one account, and this account is all one account, so let's calculate that. Hopefully this ends up being 0. Let's see. Goes up by that and down by those 3. All right, good. And then goodwill, of course. It's just the 880. So now let's do the NCI. These are credits in the NCI account. So now it's going to be these added up. Now let's see if our assets and liabilities balance. Here we go. Drum roll. Oh, it's not going to work because I forgot to pull retained earnings from above. And there we go. You're all set.